People shop for a home, the number that usually drives every conversation is the monthly payment, not the sales price, not the interest rate by itself, not even the down payment on its own. It's the question that sits behind everything. What will this cost me each month, and can I live comfortably with that number? What makes this tricky is that the monthly payment people hear in casual conversation is often only part of the story. Sometimes it means principal and interest, sometimes it means everything combined, sometimes it assumes one loan term, sometimes it assumes another, sometimes it does not even include taxes, insurance, or mortgage insurance at all. So in this video, I want to slow this down and explain how lenders actually calculate monthly mortgage payments for conventional loans using the same framework agencies require without any shortcuts and without hype. We're going to talk about what principal and interest really mean, how loan amount, rate, and term interact, why two homes at the same price can have very different payments, what is usually added on top of principal and interest, how amortization works over time, and how to think about payment changes when you adjust your offer, price, down payment, or loan amount. The goal here is clarity. So if you understand how the math works, you are far less likely to be surprised later in the process. Let's start with a basic distinction that matters a lot. There is your principal and interest payment and your total monthly housing payment. Principal and interest are the parts that pay back the loan itself. Principal reduces what you owe. Interest is the cost of borrowing the money. But most borrowers do not just send principal and interest each month. In many cases, the payment you actually send to the servicer also includes property taxes, homeowners insurance, mortgage insurance if required, and sometimes flood insurance or similar coverage. Those items are often collected monthly and held in what is called an escrow account. So when someone quotes a payment number, the first follow-up question should always be, is that principal and interest only, or does that include everything? Because those two numbers can be hundreds and hundreds of dollars apart. For a fixed-rate conventional loan, lenders calculate the principal and interest portion using a standard amortization formula. That formula is designed so that if you make every payment on time and keep the loan for the full term, the loan balance reaches zero at the very end. The formula uses three inputs: the loan amount, interest rate, and the length of the loan. Change any one of those and the payment changes. That is it. There's no separate underwriting version of the math, no negotiation in the calculation. It's the same structure that applies whether the loan is small or large. What changes is the scale. The first variable is the loan amount. That is the purchase price minus your down payment plus or minus any finance costs that apply. So if two buyers have the same interest rate and the same loan term, but one borrows more money, that buyer's principal and interest payment will be higher. That sounds obvious, but this is where small pricing decisions start to matter. An extra $5,000 or $10,000 in purchase price does not just disappear from the paperwork, it's added to the loan. And that higher loan balance is what the payment formula is applied to. So when people negotiate, one useful way to think about this is not only what is the price, but also how does this change the amount I am financing? Because that is what the payment formula actually uses. The second variable is the interest rate. The rate affects how much interest is charged on the outstanding balance over time. With a fixed rate loan, the rate stays the same for the entire term. Even small rate differences can meaningfully change the payment, not in a dramatic way, in a steady, cumulative way. That is why two buyers borrowing the same amount for the same number of years can end up with noticeably different monthly costs. One locked at a lower rate, one locked at a higher rate. Same house, same down payment, different payment. The third variable is the loan term. Most people are familiar with 30-year loans, but conventional financing can also involve 20-year terms, 15-year terms, or other amortization schedules. Shorter terms mean you pay the balance faster, so each payment has to include more principal, which usually makes the monthly payment higher. Longer term means the balance is spread out over more months, so the payment is usually lower, but interest accrues for a longer time overall. That is why you will sometimes see two payment quotes for the same loan amount and rate that look very different. One is for 30 years, one is 15. Same math, different horizon. Let's walk through a conceptual example rather than quoting a table. Imagine three scenarios. Same home, same down payment, only one variable changes each time. In scenario one, a higher price. You increase your offer price, your loan amount increases, the formula applies to a bigger balance. Your principal and interest payment goes up as a result. Scenario two, higher interest rate. The purchase price stays the same, the loan amount stays the same, the rate is though higher, which the formula then charges more interest on that balance. and the payment goes up. Scenario 3, short term. Price and rate stay the same. You move from a 30-year loan to a 15-year loan. You're paying the balance back in half the time, so each payment has to do more work. Therefore, the payment goes up. In all three cases, the change is mechanical. It's not subjective, it's not discretionary, it's just math. During a home search, people often see payments move around a week. That usually happens for a few reasons. Rates move, the estimated purchase price changes, the down payment changes, property taxes differ, sometimes greatly, between neighborhoods. Insurance quotes can differ by location and property type. So when any of those inputs move, the estimated total payment moves too. That is totally normal. What matters is understanding what caused the change. Was it a pricing shift, a rate update, a term change, maybe escrow accounts are being adjusted, or a combination of those? So knowing this helps you make clearer decisions instead of reacting emotionally to a single number. Another piece that often surprises buyers is how payments are split early in the loan. In the early years of a fixed-rate mortgage, a larger portion of each payment goes towards interest, and a very small portion goes towards principal. Over time, that flip-flops. Later in the loan, more of each payment goes towards principal, less goes towards interest. The total payment stays the same. It's just the mix that changes. That's about understanding how the amortization schedule is built mathematically. Understanding that helps set expectations, especially for buyers who are looking at their first few statements and wondering why the balance is not dropping very quickly at first. Now let's talk about the rest of the monthly payment. For many conventional borrowers, the servicer collects property taxes, homeowners insurance, and mortgage insurance if required. Those amounts are estimated at closing and then adjusted over time based on actual tax bills and insurance premiums. That means the total monthly payment can change even though the interest rate on the loan never changes. So if the property taxes go up, the escrow account portion goes up as well. If the insurance premium rises, the escrow account portion goes up as well. That is separate from the loan amount. So when you budget, it's wise to focus on the full payment, not just the principal and interest, because the reality is taxes and insurance do tend to rise from one year to the next. So it is very common for your overall payment to slowly drift upwards over the years. This comes up a lot. Two houses in the same price range, two buyers with similar down payment, two very different monthly payments. Often the difference is tax rates, HOA dues, insurance costs, flood zone requirements, mortgage insurance, or the loan term. This is why payment comparisons should always include principal and interest plus the non-loan cost. Otherwise, you're not really comparing apples to apples. From an underwriting standpoint, the monthly payment matters because it's used in your debt-to-income ratio. That ratio compares your monthly obligations to your gross monthly income. The housing payment is usually one of the biggest pieces in that calculation. So when lenders estimate payments early, they're not doing it casually. They're trying to understand how the home fits into your broader financial picture, whether the payment aligns with program limits, and whether the loan structure makes sense. That is another reason to look at full payment instead of partial ones. When you're touring homes, payment estimates can be used as a planning tool rather than a source of stress. For example, if we offer at this price instead of that price, how does the payment change? If we put a little bit more down, what happens? What does this look like at a 15-year term versus 30? How much of this payment is taxes and insurance? Those questions help you frame decisions before you get emotionally attached to one property. A few patterns show up repeatedly. Assuming the payment someone quoted online includes taxes and insurance when it does not, comparing a 15-year payment to a 30-year payment without realizing the term change, focusing only on rate and ignoring the loan amount, forgetting HOA dues, or assuming today's estimate will stay identical for a month without any changes. None of those are mistakes, they're just gaps in information. So the fix is to slow down and ask what inputs were used. Here's the core framework. For conventional loans, principal and interest are calculated using a standard amortization formula. The formula depends on the loan amount, interest rate, and the term. Higher balances raise payments, higher rates raise payments, shorter terms raise payments. Taxes, insurance, and mortgage insurance are usually added to create the full monthly payment, and escrow items can be changed even when the rate does not. So once you understand all of those pieces, the numbers become far less mysterious. If you're thinking about buying or refinancing and want to understand how price, rate, and loan structure affect your monthly payment, use the link below to book a call with my team. These conversations are most helpful early before an offer is written because they can save stress, time, and surprises later. And if you want clear explanations about how lending rules actually work in today's market, make sure to hit that subscribe button. My goal is to help you make informed home buying decisions with confidence and ultimately win with Wade. We'll see you in the next one.